Hey traders, today I want to tell you about 4 day trading strategies for beginners. Now, 6 years ago when I was getting started, I wish somebody would have told me about these basic concepts. It would have saved me a lot of time, money, and energy investing in all of their indicators and strategies. These concepts will serve you well for years to come, and they will become a basis of your trading. Anyway, let's get to the video. Okay, so first we need to quickly explain a couple key concepts for reading a price chart. I'll do a more in-depth video on this in the future, but let's start with this. Taking Apple on the minute chart as an example, every price movement on the chart can be broken into 2 phases. Range consolidation, where price is moving sideways, accumulating orders as it finds balance in the market, and range expansion, where prices move away from the consolidation zone, breaking to new areas of balance. This is what we call price exploration and price discovery. To become a profitable trader, you need to be able to anticipate when price has consolidated enough and is likely to enter the expansion phase, also known as a breakout. With that in mind, I'm going to share with you 4 consolidation chart patterns that are notorious for breakouts. You will be able to take these patterns and build your own strategies like we have. I trade these patterns every day in the markets. They have the best risk to reward ratios, and we know that there's a lot of traders out there, technical or not, looking at these patterns and expecting a breakout. First, we have the channel pattern, a consolidation of price centered around 2 parallel trend lines. Starting with the initial spike up, or the expansion, price moves into a consolidation where, in this bullish example, buyers are accumulating price at the higher lows and sellers are failing at the highs. The bullish spike gives us a long bias, often leading to price breaking higher. Number 2, the head and shoulders pattern. Usually found at the tops and bottoms, head and shoulders patterns are notorious for reversal signals. They are made up of the left shoulder, the head, and the right shoulder. Combined with signs of exhaustion, they can be shorted below the neckline. Check out your favorite charts. Zoom in to the tops or bottoms. See if you can find a head and shoulders pattern. Number 3, the flag pattern. This flat top or bottom consolidation is one of my favorite patterns of all time. Usually topping off near an area of support or resistance, the battle lines in this pattern are very clear. Buyers and sellers are accumulating their positions in the anticipation of a break as price forms a tight wedge, making the breakouts out of these patterns some of the most powerful breakouts that I've ever seen. Number 4, the wedge formation. Similar to the flag pattern, this formation consolidates towards a major breakout. However, indecision is more prevalent here as buyers and sellers are matched, and the direction of the expansion is less certain. Be careful trading these without having the full picture. Now, these 4 patterns are essential and widely traded. They're a basis for traditional price action trading, but this isn't a secret to keep to yourself. It's actually a good thing that they're popular, because these patterns will work better when there are more people, more market participants in play. What we do is combine high probability setups like these with market auction theory, volume analysis, and order flow analysis to pinpoint areas on the chart where buyers and sellers are likely to react. Let me show you an example. This scenario starts with an initial spike up. The market is in discovery mode, looking for balance. They find a high, and price enters into a wedge consolidation pattern. We get a spike up in volume, which precipitates a move higher. Price breaks out of the wedge, finding resistance at the previous high. Next, sellers take control and drive price down to the previous trend line, but fail to break through the volume point of control, the area of most fair value, according to market auction theory. Buyers are now taking control. We see buyers begin to accumulate while holding the ascending trend line as a variety of bullish macro patterns begin to appear, confirming the move. We anticipate the break and start into a long position. Now price breaks out on high volume as buyers pile in and stops above our run. The perfect trade. Now, let's take a look at Apple again. this time with a time-based volume histogram at the bottom. You'll see that price finds a flag consolidation range. As price nears the highs of this range, there's an influx of volume and buyers initiate into the move, running stops and sending price into expansion. The volume confirmed the breakout. But this bullish move was within an even larger move. Let me know in the comments if you guys spotted it beforehand. Price here is in a large bull flag, topping off near the previous high of day. As price continues higher, smaller consolidations appear to break to the upside. Buyers are accumulating a position. Finally, as price reaches that high, we get a breakout. The volume confirmed the breakout. If you want to learn more about how to pinpoint those entries and exits, how to manage your risk, and how to become a profitable trader, join us. Hey traders, if you liked what you saw, don't forget to hit that like button, as well as subscribe for more content. Now, if you want to watch me trade live every morning at 9 a.m. Eastern Time, join us in our live community, the private network for active day traders.